Navigating the world of investments presents an essential choice: crypto or traditional. The safety of well-established traditional assets contrasts with the appeal of large profits in the world of cryptocurrencies. This exploration looks into the pros, cons, and considerations of each, aiding in the decision of where to allocate your hard-earned funds. But before we start, be sure to smash that subscribe button and don't forget to click the bell icon to get a notification when we update videos like this one. Cryptocurrency investment. Crypto investments offer potential for substantial gains due to volatile markets. With cryptocurrencies like Bitcoin and Ethereum, early adopters have made significant returns. However, there is a huge risk involved because prices can change dramatically in a short amount of time, which can result in significant losses as well. Before committing to any investment option, it's critical to have a solid understanding of the cryptocurrency industry. Stay current on trends and take your risk tolerance into account. Traditional investments. Traditional investments encompass assets like stocks, bonds, and real estate. They're renowned for their stability and long-term reliability of returns. These assets, as well-established, regulated, and well-known choices for many investors, comparatively to some alternative assets, traditional investments frequently have lower risk levels. However, potential negatives including perhaps lesser growth potential and restricted access to specific markets in comparison to riskier possibilities like cryptocurrencies. Pros of crypto investments. Crypto investments offer an opportunity for significant returns due to their high volatility and innovative nature. They promote financial inclusivity by allowing access to decentralized international markets. Transparency and security are provided by the blockchain technology underpinning it. Additionally, diversification outside conventional assets is made possible by cryptocurrency. Risks are posed by their swift price volatility and regulatory uncertainty. Before considering crypto investments, it is imperative to conduct thorough market study and understanding. Cons of crypto investments. Crypto investments come with significant downsides. It is a high-risk endeavor because of the crypto market's tremendous volatility, which can cause quick and significant losses. There are inherent dangers due to the absence of regulatory monitoring and vulnerability to fraud and hacking. Moreover, the complexity of cryptocurrencies and blockchain technology can deter newcomers, requiring a steep learning curve. Pros of traditional investments. Traditional investing has a number of benefits. Stocks and bonds among these investments frequently provide stability and steady growth over time. Because of established market norms and regulatory control, there is less chance of fraud and swindle. Traditional investments are also ideal for long-term wealth building and retirement planning because they often produce steady but moderate returns. They appeal to a wide spectrum of investors with different risk tolerances because they provide a sense of familiarity and accessibility. Cons of traditional investments. The drawbacks of traditional investments include probable lower returns relative to riskier assets, restricted access to some markets, and vulnerability to economic downturns. Due to administration expenses, they may also be less flexible and charge more fees. Traditional investments could not offer as much diversification as more recent alternatives. Overall, their stability and dependability may occasionally come at the expense of a slower rate of growth and less innovation in markets. Risk tolerance. The ability and willingness of an investor to deal with the uncertainty of future investment losses and losses is referred to as risk tolerance. It is affected by things like financial objectives, time horizon, and level of comfort with market changes. A low risk tolerance could lead to a preference for more stable options like traditional investments, whilst a high risk tolerance might increase exposure to risky assets like cryptocurrency. Investment goals. The exact goals you want to accomplish through your financial assets are known as investment goals. These objectives can be to increase wealth, pay for retirement, save for college, or buy a house. Whether your goals are short-term or long-term, low risk or high risk, your investment approach should be in line with them. Understanding your investment objectives clearly will help you choose the right assets, risk tolerance, and time horizon for your portfolio. Diversification. The goal of diversification is to reduce risk by the distribution of capital among various assets. Diversification aims to reduce potential losses by avoiding over-reliance on one investment. A balanced portfolio is built by combining various asset classes, sectors, or geographical areas. Diversification serves to lessen the effects of bad performance in one sector on the total investment. While it cannot completely eliminate risk, with the help of this method, it should be easier to generate consistent returns over the long term and develop a more secure portfolio. That's all for now. I hope you enjoyed the video. Let us know your thoughts in the comment section. See you in the next video. Please subscribe to our channel and click the bell button to receive new updates. Stay tuned.